Thank you for joining us in the harbor for a very special episode as we are joined in studio with Andrew Fentress, managing partner of Acres Capital. Together, Andrew and I will discuss how Acres Capital came about, what his background is. We'll hear some timeless wisdom around why being present and being active is incredibly important in periods of volatility and uncertainty. And we'll also discuss the U.S. housing market, more specifically, where Acres Capital is finding opportunity on the real estate debt side of the equation and multifamily housing. Thank you for joining us. This is In the Harbor. Welcome back to In the Harbor, the podcast where sports, leisure, and finance meet. Today, I'm hoping we talk about all three of those topics as we're joined in studio for the first time with our very special guest, Andrew Fentress, managing partner at Acres Capital. Welcome to the pod, Andrew.
Great to be here.
I think, why don't we kick it off? Let's get a little bit about your background and then how you eventually founded Acres Capital.
Sure, happy to get into it. So I started my investment career at Morgan Stanley, 1997. It was the heyday of equity volatility and markets that were moving around in big swings each and every day. It was sort of a baptism by fire, I should say. We were trading everything from equity derivatives to cash to convertible bonds, and it was a great training ground for risk management. And it really helped me understand, the values and the principles behind how do you invest in a controlled format? And on the back of that, we started a firm in 2004 that moved into credit investing because I felt like there was a real controlled way to make returns. And that evolved from corporate credit to looking and learning more about the real estate side of the market. And again, on this adventure to find stable, consistent return streams that we could ultimately apply a little bit of leverage to, but where we knew we had a very, very predictable set of cash flows. And so the credit side has always served us well in that regard. And I think in starting Acres, what we really wanted to do was just to provide an asset class to investors that really hadn't been available. Commercial real estate loans have always lived predominantly in the U.S. banking system. And so this was a way to bring it out of that and deliver it to institutions and individuals in a high-quality way. We curate everything ourselves. We underwrite it, we document it, we manage it, and we put a lot of our own money into it. And it served us well, and it served our clients well.
So that's interesting timing. So in the late 90s, you were still on the equity side at Morgan Stanley?
That's right.
So we all know what happened leading up to 2000. Mm-hmm. And then when you got into credit, eventually real estate, and then, of course, 2008.
Absolutely.
So there was a trial by fire, really, on a couple fronts.
Yeah. I've seemed to have found my way through a few different cycles, but I think, it all harkens back to a couple of really important lessons, which is, one, you have to stay in the game. You have to stay invested. You have to keep yourself basically on the field, if you will. And a really an important mentor to me in that early days, when we were going through one of those early cycles, it was part of the dot-com, I'm sure, but it was really nasty, and there was a lot of red on the different screens, and the lights were ringing, and he said to me, Andrew, you got to pick up the phone and you got to make a market. You got to be there. That's what our franchise is about. Our franchise is about being available to your clients when they need you the most. And what I took from that helped me in 08, 09 when the same volatility in the world got ugly. We were present, we were making investments, we were deploying capital. And it happened again in COVID. We were basically sent home by the state of New York. We were all told to vacate our offices. And I remember writing an email to our team. It was the last email that I wrote before shutting my computer off. And it was something to the effect of, I've seen a few of these. I don't know what the journey's going to be like as we go through this mess. I know for sure we're going to get to the other side of it somehow, some way. But in between, we're going to find some great opportunities. And in fact, we did. And we bought a platform that led to one of the big pools of capital that we manage today. So those periods of volatility are opportunities for the right set of folks with the right set of mindsets, and I think we've done a good job of navigating them.
Well, and I think that's good advice generally. The be present and be on the phones. It's easy to play the turtle and kind of duck and cover in periods of volatility, but I think those that are picking up the phones and are present and active are the ones that are going to find the opportunities.
Indeed.
When you and I were speaking over coffee this morning, you had an interesting story, I think, going back to taking young traders or possibly interns to Atlantic City and helping you identify who you want in the firm. Let's hear a little bit about that.
Yeah, so we used to take interns and prospects down to the casinos and give them $1,000 and let them go play. And what we were always looking for are the ones that stayed the longest at the table and came back with just a modest return. There were always a couple that doubled or tripled their money in a short period of time, and that's obviously great. You like to make money, but on the other side of those guys are the same outcomes on the other side, turned it into zero.
Right, because the risk budgeting is probably non-existent. Right. There's a little bit of chance and luck involved.
That's right. And so we always wanted the ones that stayed at the table and were able to just grind out returns because, as I've always felt in the investment world, the opportunity sets to make returns are there every day in small pieces, so you can make a little bit all the time, and then you get great opportunities, few and far between, but you got to be there to recognize them. You can't, come out of hiding and hope to find them. You got to be in the market every day to recognize them when they come. And so our strategy is designed to do that, which is to take very steady and consistent pieces of return, put them all together, do that every day, do it consistently, and then occasionally you'll get great opportunities, but you got to be in the game to recognize them.
Absolutely, and it's not about hitting the home run on the large leverage bet, hoping you can increase your returns that way. It's singles and doubles.
Absolutely.
Consistently.
Absolutely.
Thinking back to the strategy at Acres Capital, where are you finding opportunity right now?
So we've been pretty consistent in our approach since we started, in that we've identified a very large trend that we've participated in for the last 12 years, and we expect to continue to participate in, which is in the housing space here in the United States. So as most everybody knows, generically, the United States is just fundamentally undersupplied. And so what we're doing is helping great sponsors build and develop and deliver A-class apartments to the marketplace. And in a credit strategy, if at the end of our loan term, when we approach our maturity date, if we've done that successfully, we've got an A-quality asset in an A-quality market with an A-quality partner, and they have a very high probability of getting financing that's needed to repay us. And I'll give you a little bit of statistic around the housing trend. This is a fun one that I like. In 1965, there were 50 million people employed in the United States, and we built 1.4 million housing units. Last year, we had 150 million people employed in the United States, and we built the same 1.4 million units.
Wow.
So, and at the same time, we've had a lot of the existing housing stock get destroyed or shrink or become obsolete every year, either through natural forces like, sadly, the wildfires that hit California, or floods that hit parts of the East Coast last year, things just becoming obsolete, roads going through neighborhoods, whatever it might be. So we're just not keeping up with the demand for units in the country. So that's just a theme and a trend that we've been on. We expect to stay on it. And we're working every day with the same and improving partnerships and sponsors to deliver that to the country.
In that vein, I think it's interesting, post-COVID, and then with different natural disasters that we've seen over the last few years, how have you seen kind of housing shift? I mean, you look at the amount of corporations that are moving to tax-friendly states. You see that in Florida. You see that in Texas. I think Nashville's been a hot ticket item. Mm-hmm. So how are you seeing that shift from a housing development standpoint? And do you find there's more demand for being in these kind of secondary cities? and close to the action. Maybe not necessarily housing in the suburbs, but looking for an apartment where everything's walkable.
Mm-hmm. There's definitely a dispersion, is how I think about it, from what were the sort of the major population centers that I looked at when I was coming out of school. So you either went to San Francisco, Chicago, New York, essentially.
Right.
And now, people can work all throughout, the Southeast. All the Carolinas and Georgia were places that you would go, but you didn't have a place to work there. And now, either through remote work or companies relocating or tax advantage, as you brought up, going to places along the Eastern Seaboard or in Texas, there's a lot of population migration for corporate reasons. And then there's also the quality of life, and I think that really got catalyzed by COVID and people being able to work in different locations remotely. So it's spreading out. But at the same time, these great American cities, they don't die. And I think some of them tried to. We talked a little bit about, the revival in San Francisco. We were together earlier this morning. They've just had a terrific 180 out there. And even in Chicago, and we're here, outside of Detroit, we're talking about what Dan Gilbert did in the city of Detroit. So these great American cities, they go through cycles, but they don't die. And I think that's a great thing for our country, the dynamism and the way that, cities can go through different parts of their evolution. And so we're always looking around and finding where these revivals are happening or great pockets of growth, trying to find trends where we can be a little bit ahead in going with our sponsors to these markets and helping them, develop property and deliver great assets.
How thinking about the sponsors, then obviously there's a partnership that's involved there. So I assume that lasts over many projects and many years. You're working with some of the same sponsors.
Indeed, and that's in the lending business. That's really the holy grail, is being able to do the same type of transaction with the same sponsor multiple times. I always say in our business, we really are underwriting three key risks: counterparty risk, execution risk, and business risk. So the first is the most important, is who is your counterparty and what's their ability to deliver whatever project we're working on together on time and on budget, and can they do it consistently? And if you can find that partnership and that capability, it pays to do it again and again and again, because the execution risk is pretty well easy to, it's not easy, but it's fundamentally, we can understand that. What is it to deliver, construct, to build, to renovate, whatever the project calls for. And then the business risk is, once it's completed, does it have a reason to exist? Is it going to get occupied, generate revenue, and run through its cost structure to deliver the profitability that it was supposed to? And, in the instances where we've had problems or missed, it's because of the counterparty. So we're always working to do more with the same people that have done well by us and vice versa, and then find others.
And I would imagine we touched on it a little bit, but thinking about the market, which has predominantly been dominated by the banks, especially when we're talking middle market lending. Banks are kind of exiting that scenario. So if you go back to 2012 through today, I would say there's a much wider opportunity set.
Yeah, first of all, if you just take a step back and think about the market itself, it's a big market. It's about a $4 trillion market if you add up all the commercial mortgages in the United States. Historically, about 70% of that market has been owned by the U.S. bank system. And that goes back over 50 years. I mean, and if you really look at the history of the country, look, we're in a great place as a nation. We've arrived at this place on the back of the financial system working well for America. And I think you can't criticize, the banking system for what it's done, because I think generally it's worked. I think what's changed is the notion that illiquid assets are being housed in basically 10 times leveraged structures that offer now minute-to-minute liquidity or liquidity on demand. And we saw that in 08-09. We saw it again in 22 post the rate cycle, what happened with Silicon Valley Bank and First Republic. And, those weren't credit problems. Those were fundamentally interest rate hedging problems that they didn't manage their rate risk well. But I think what's happened is that on the back of that most recent crisis, the Fed and the regulators decided they didn't want to have another problem on their hands. And so they raised the capital charges for holding mortgages and loans from 5-10 points to 60 points in some cases, which is really forcing the banks out of the single name mortgage market and single name loan market. So rise of private credit, rise of mortgage lending. And so we're really doing the same thing. We're just putting it in a format, in a fund structure where we're one turn of leverage instead of 10.
Right.
And the assets and liabilities are matched. So there's no run on the bank scenario for our fund. And we think doing it just in a much more controlled, match-funded way, delivers our country the same capital that it needs to do what banks have always done, but just does it in a much more controlled format, just better packaging, essentially.
So if you think about our audience here on the podcast, it's primarily comprised of financial advisors.
Mm-hmm.
And just observationally, over the last decade, the increase in private strategies available to advisors is, what used to be an institutional market is much more focused on the advisor.
Mm-hmm.
And the amount of private credit funds coming out, for instance.
Yeah.
So how would you think about, something with Acres versus a private credit strategy?
Yeah, so I think it's important to peel the onion one layer if you're looking at private credit writ large to understand what is the underlying collateral, what is the underlying strategy doing, what benefit are they providing to the borrower, and what is it being used for? There's a lot of different things. So most of corporate private credit, and again, I came from this world, so I have a firsthand knowledge of it, did it for a decade, is lending to middle market companies or companies that are backed and owned by private equity. And they're certainly capable and smart, and they're driving value and growth in companies. And the financing that's being provided to those owners of businesses is being used for growth or acquisition or sometimes dividends. And you hope that the business continues to perform. Businesses fundamentally are more prone to cycles than some harder assets. And if you step back from the business lending and private credit and you look at, say, what are the other pieces of the economy that credit can help finance? And there's asset backed, there's auto, there's credit card, there's all sorts of aircraft, there's shipping, there's rail car, there's always, and then there's, of course, real estate. And so there are different categories of credit that needs to be provided into our system and fundamentally has been provided to our system over the decades. But again, it's been fundamentally given to the system or provided to the system by the banking group. And the banks are they're being guided in a different way now. And so it just happens that there's now an industry that's there to step in and fill that. And I think fundamentally do it in a way that's, as I said, match funded and with a lot less leverage. And so it just removes sort of the big cycle risk of having banks go through a failure dynamic. And so I think fundamentally it's healthy, meaning I think the same capital is going to get delivered. It's going to be done in a way that's better packaged and better structured. And I think for the audience who's thinking about this asset class is, where does it fit best for my client? What type of risk are they willing to take on? And what's the volatility parameter? And what do the different asset classes look like?
Do you think, I'd say that real estate kind of gets lumped together from the equity side too, mm-hmm. and then maybe the debt side is overlooked a bit from an advisor perspective. Would you agree with that? Or?
Sure. I think everybody thinks about real estate or historically has thought about real estate from the equity side. And, where you're buying a building or an apartment complex or an office building, whatever it might be. And it's been in different equity funds, core funds, value-add funds, whatever the flavor was. And largely because, again, the financing side of the real estate equation, by and large, came from the banking system.
Right.
And so it really wasn't available as an asset class. If you wanted to have real estate credit exposure up until, 4 or 5 years ago, you had really, you you could invest in a bank, and they would likely have a lot of mortgages on their books. You could buy CMBS, those securities that are created and packaged and sold by the street out to the investment community. You could buy REITs, on the debt side of mortgage REIT. So there really weren't a lot of options. And so when I was saying at the beginning, now we're delivering this asset class directly to consumers, whether or not they're institutions or financial advisors and their clients. For the first time, it is true. I mean, it's really coming now in a pure form. We originate everything, we document it, and we hold it and manage it through. And it's not securitized and sold. We don't sell to the street. So the only point of access is directly through a manager like this.
And that's interesting because then the investors essentially are taking the place of the banks. So you're becoming the bank.
That's right. We're filling the same function that banks have provided the system and the economy. And we think, banks are going to go to, a place where they're investing in much more liquid securities. And I have a little bit of a conspiracy theory on why it's happened. Some of it has to do with the fact that I think, and we're seeing it now from the Treasury Secretary, that he's creating a lot of room in the bank regulatory regime by dropping capital charges for holding treasuries so that the banks can be a new buyer of our treasury paper as we're running massive deficits and they need a new buyer.
Right. That's an interesting thought too. I wonder, there's still the international buyers I think are still active in treasuries a little bit, but not nearly as active as they once were.
Yeah. Some of our international politics have taken a few buyers out of the marketplace. I'm thinking Russia and China and a few others.
That's certainly true.
So we're looking for new customers at the Treasury Department. And I think he's identified a big one in the U.S. bank system.
That's interesting. I remember, when we look back to the European market and negative rates,
mm-hmm.
I mean, you even had European companies were able to issue debt at negative rates.
Yes.
But at the time, maybe U.S. Treasuries were yielding, even if you could get long-term paper at 3%, that looked unbelievable.
That's right.
And I think because of that demand, it created this artificial ceiling on the yield because every time it hit 3% for a few years there, it was dropping. And that was kind of the ceiling.
Yeah.
So it's definitely, globally, it's a much different world now than what we saw back then. But if we shift gears a little bit, I know we're on the clock, so why don't we talk a little bit of golf? I think you're going to play Oakland Hills this afternoon, so it should be a nice, cool day for it. In that vein, what is your favorite golf course and why?
Shinnecock Hills is my favorite golf experience. I think it's the purest golf course and test of golf that you can find. There's no trickery. Most of the shots are right in front of you, and it's just challenging you to go hit the best one you can. And every time I'm out there, I step onto that first tee, and I'm not a member, I'm a guest when I'm there. So you get an extra special feeling of this is a place where great golf has been played. Great guys have won tournaments here, and it's just a special view. It's a special feeling. The ground feels different. It's just a wonderful, wonderful place, and it's there to, you're just there to play and hopefully play a great round, which doesn't always happen because it's tough, but it's a special experience.
Well, and that's the nice thing about golf is, some people get too focused on the golf itself, and they're worried about this shot and that shot. But if you just think about the fact that you're outside for 4 hours with your friends, I mean, it's a very cathartic experience. You can find relaxation on the golf course that way.
For sure. And it's, away from going to those places like Shinnecock Hills, the special part about the game, and I came to the game very late. I didn't play until after I graduated from college. But I've just had a wonderful experience with the game, with my friends, now with my son and his cousins. And it's just a way to get out and be together and to share stories and laugh and just enjoy your time together. And it's, it's harder and harder with all the technology and the phones and the distractions that we all have to find 4 or 5 hours that you can carve out with somebody away from all of that. And it's special time. And I love it for that reason mostly.
Absolutely. And I think if we look at my trusty chart, U.S. Open chart back here for Shinnecock Hills, let's see, 2018 was the last U.S. Open. There's Shinnecock.
And it's coming next summer.
And do you know who the winner was in 2018?
I'm looking on the board. I'm cheating.
You're cheating.
That's seeing Brooks' name up there. But I do remember that event. That was the one, I think, where Phil grabbed his ball before it stopped rolling. It was very...
oh, yeah. I still see replays of that video all the time.
Yeah.
It was,
And there was, I think that was also the time when they were saying they lost the greens because they kept having to water number 7 in between guys coming through. Yeah. That's a tough shot, but to have it so that they had to water it in between groups is pretty dramatic.
Absolutely. I think...
But I'm really looking forward to Oakland Hills. I've not played it. Certainly read a lot of the history of it. It's got a rich history. A lot of tournaments have been played there. I was surprised at how many tournaments have been played there over the years, not just U.S. Opens, but all the amateurs and the Ryder Cup and that kind of thing. So I'm really looking forward to it.
And the history of Oakland Hills is amazing. It goes back to, Oakland Hills' first pro, which was it Walter Hagen?
Yes.
I think it was Walter Hagen.
Yes, it was.
So, it goes back to the old days of golf.
Yep.
You'll be able to see the clubhouse under construction, which is incredible. I mean, just how fast it's coming together, and now they're getting the siding on. It's going to be, it already was a gem in the Midwest, and I think with the brand new clubhouse, even though, the history of the old one, but much of it's the same layout, I think you'll see how powerful it is when you drive up this afternoon.
Yeah, Sean told me a story of, sadly, when the fire was there, and the firefighters had lined up in a row, and they were passing all of the memorabilia and all the trophies and the things that were just historically significant. They were just passing them down the line to preserve it all. It's just a great, I haven't seen the image, but I've got it in my head. It's just, I could see that's a great visual.
Yeah, and you have those old 100-year-old structures, balloon frame construction.
Yeah.
So now I'm putting on my firefighter hat, but they can very flammable.
Yeah.
No fire stops between floors, which is the problem. But
right.
I think they did a great job preserving history, and with the layout of the new clubhouse, it's going to look very similar.
I'm thrilled. It's going to be a great afternoon.
Updated. Well, Andrew, thank you very much for joining us.
Great to be with you. Great to be with everybody out here. Thanks for listening. I hope it was helpful.
Absolutely. We're glad for your insight, and we'll see you next time in the harbor. We hope you enjoyed this informal, impromptu conversation in studio with Andrew Fentress. This is In the Harbor. We're glad you're here.